ETFs are all the rage these days. I mean, you hear them all over the time. You got SCHD, VTI, VOO, QQQ. You can just continue to name ETFs all the time. Now, you may be wondering, why are people talking about these ETFs? Well, it's simple. They are a simple investment tool to help you to create a great portfolio that can last a long time. You can just buy and hold just one or two or even three, and you can just continue to grow that year upon year for 10, 15, 20 years or even longer. And the hard part about ETFs is now there are just so many ETFs out on the market. There's over 3,500 different ETFs on the market. So how to pick one or even choose one? Today we're going to be talking about two ETFs in particular to grow a growth portfolio. Now these two ETFs are part of Schwab's ETFs, and they are SCHG and SCHD. These two ETFs can make you one of the greatest growth portfolios you may have. And the best part about this ETFs are together they can beat the S&P 500. Now, it may not happen year upon year, but it can happen over a good long period of time. So today we're going to be talking about this, and we're going to be talking about how you can add these to your portfolio. Hey guys, my name is Steve, and I run the Frugal Expat website, where we try to help people to save more, invest better, and to travel more. And if you like this content, make sure to smash that like button and subscribe. And we will continue to create great content to help you to invest better and save more. Now, today we're talking about two of the great Schwab ETFs, and that is SCHG and SCHD. Those are two great ETFs that Schwab creates to help you to create a great growth portfolio. We're going to start off with SCHG. Now, if you're looking for a great growth ETF, SCHD could be that great growth ETF. Now, it is compared to some of the better growth ETFs like QQQ and VUG. And over the last 10 years, QQQ and SCHG has performed quite similarly. Now, in the last year, in 2024, SCHD did grow about 40% in that year. That means if you had $100,000 invested, you would have made about $40,000 in capital gains. Now, this is some great news for those investors, but I mean, as you can see, the market goes up and down, so not every year is going to be like 2024 or 2023. Some years could be like 2022 when the market took a massive dip. So if you have a great long horizon and you have the patience and the time and the stomach to last those ups and downs, SCHG could be a great ETF to add to your portfolio. Now, if we look at some of the things in SCHG, we can see that the top three holdings are Microsoft, Nvidia, and Apple, and these three holdings do make up around 30% of the ETF. Now, the ETF does have 229 different holdings, and it has performed pretty well over the long term. Having three holdings making up 30% may not be the diversification you were looking for, but with 229 different holdings, it could add just a little bit more diversification in case those three holdings go down and some others go up. Now, if we're looking at kind of some comparisons to other ETFs like QQQ or QQQM, these ETFs do track the NASDAQ 100, and it has 100 different holdings. SCHD does track the Dow Jones Large Cap Growth Index, so it's got a little bit more of this large cap growth, and it's also got some financials unlike QQQ. QQQ does not hold financial companies, so you have a little bit of difference in those two holdings. Now, if we look at some other things, part of SCHG, you have a dividend percentage of less than 0.5%. So you are not getting a very good dividend. But if you're looking for dividends, SCHG may not be that ETF to give those dividends. It is a growth ETF, so those companies are reinvesting their profits into their companies and trying to grow them for the long term. It does have an expense ratio of a 0.04%, meaning it's going to cost you about $4 for every $10,000 invested, making it a very cheap ETF. Now, if we compare that to QQQM, which has a expense ratio of 0.15%, you can see that SCHG has a cheaper expense ratio. That means over the long term, it's going to cost you less to hold this ETF. Now, if we're looking at some stability in case the markets take a turn, that's why I added SCHD. SCHD is a stable dividend growth ETF. That means it is growing their dividends year upon year and having companies that have grown their dividends at least for the last 10 years. Its dividend growth rate is around 11.59% over the last 5 years. That means you're seeing a growth that is better than like VIG or DGRO. And the great thing about SCHD and SCHG is there is 0% fund overlap. That means with adding SCHD, having some value and some stability, a part of your portfolio, that is a good thing. That means you're not really overlapping on having too much into one different company. The other good thing about SCHD is you have a great dividend yield. Now, the dividend yield is sitting around 3.8%, but it ranges between 3.3 and 3.8, so you're going to have a pretty good yield compared to some other different dividend companies, dividend ETFs as well. You will also have some great solid companies like Pfizer. You're going to have BlackRock. You're going to have Lockheed Martin and Coca-Cola and Broadcom. These are some great companies to have in your portfolio. Now, I just said Broadcom, and that was a mistake. Broadcom is not part of SCHD. Now, as we can see, the expense ratio is 0.06%. That means it costs about $6 for every $10,000 invested. And if you add up SCHG and SCHD together, you're talking about a dynamic duo of a portfolio that is going to grow your money over the long term. Now, let's take a look at some of these historic returns compared to one like VOO, which tracks the S&P 500. SCHD did start in 2011 of October, so let's put our portfolio back to 2012 and see what it's done up to the end of 2024. Now we're going to take a look at these portfolios right here in my portfolio. I have VOO as portfolio number 1. I have my portfolio with SCHG and SCHD, having SCHD around 55% and SCHD at 45%, and portfolio 3 is going to be just SCHD. Now we're going to compare and contrast kind of these portfolios and see which one is going to help you make the most money. Now we're taking a look at these portfolios. We'll take a look at the breakdowns of these portfolios, and over this long term from 2012 to 2024, you'll see that portfolio 1 is VOO, and the amount it has increased over that long term is 14.72%. With portfolio 2 with my SCHG and SCHD, you'll get 15.85%, and with portfolio 3 with SCHD, you'll get 12.65%. So as you can see over the years, you know, they have come and they have been a little bit on average coming together. And as it progressed through the 2019 to 2022, you can see my portfolio 2 with SCHG and SCHD has started to kind of take the lead. Now, yes, in 2022, they came pretty close to each other, but as 2023 came and 2024, SCHG and SCHD did go above and beyond, with VOO going right below it and SCHD kind of trailing those two portfolios. Now, that is good news for you, and as investors, we are looking to increase our money over the long term, and if you're looking to have a growth portfolio, focus on growth, this SCHG and SCHD portfolio can make that happen. Now, some people may increase that SCHG up to anywhere between 60 and 70%. I put it at 55% just to have a little bit of more stability with SCHD, because you never know how that market may turn out. So if you're looking at two of the best ETFs from Schwab to create a growth portfolio, SCHD combined with SCHD could be that portfolio that you may be looking for. So we're going to be continuing to create more content about ETFs, and that is just the two that I decided to talk about today. And so if you're looking for a great growth portfolio, SCHG and SCHD could be those two ETFs to make a dynamic duo of a portfolio. We'll catch you on next time with the Frugal Expat. My name is Steve. All right, see you later.